Welcome to the Mike the Money Coach Show, where we talk about tax tips, money making techniques, retirement planning, and more. And here is our host, Mike Vilardi, the Money Coach.
Hey, welcome to Mike the Money Coach. I'm your host, Mike Vilardi. This is our first show, and I want to tell you a little about me, who I am, and what we're going to learn during this show. I am a retired federal agent, but let me go back even further than that. I have a BBA in accounting. I graduated from the University of Massachusetts with honors. I went on to get an MBA from the University of Massachusetts, where I actually taught accounting classes. I graduated with an MBA in finance and management, and I took a job with the Ford Motor Company as a motor manufacturer's rep for the Ford Motor Company. After that, I went to the criminal division of the IRS, where I became an IRS special agent, and I served 22 years as an IRS special agent, and then I retired and went into my own tax business. WinningTaxSolutions.com is my company, and I've been in the business now for 12 years. So this course is going to be something that's unique. I'm going to take the wealthiest people, the most successful people who've made money in stocks, bonds, and became wealthy, and we're going to go through what they did and how they did it. So for instance, we're going to study stuff like this. Jesse Livermore, how he traded in stocks. Jesse Livermore, who died in the 1940s, made $1 million in the 1907 crash and made himself a multimillionaire during the 20s, 30s. W.D. Gann, who spent a lifetime on Wall Street coming up with amazing techniques. He called market highs and market lows very accurately. He had a whole system of what he did, how he did it. We're going to study these techniques and give you the success formulas for the masters, the old-time masters. We have other books here by William O'Neill, The Successful Investor, How to Make Money in Stocks. So each show I'm going to take a different person, different techniques, and give you the winning formulas so you can make money in the markets, learning their techniques and their skills. And today, we're going to talk about a couple of things. Of course, the first thing we're going to talk about is taxes. How you can save money on taxes, how you can maximize your refunds, and put away money for retirement. Now, before we go there, I just want one caveat here. I need to talk about what happened with the bank crashes, because that's important. People don't understand how banks can collapse and fail. Well, in this case, the Silicon Valley Bank in California is very simple. They had spent most of their assets, most of their depositors' money on government bonds, rather long-term bonds. So let's say they spent $100 for a bond, and at the time that they bought the bond, it was only paying 3% interest. Well, that's what they did, right? Now they're getting a 3% return. Well, the problem with that is all of a sudden we have Biden inflation goes through the roof, and guess what? Interest rates now go up to 7%. Now that same bond pays 7%. Well, they invested at 3%. So now if they want to offload that, they have to discount the price so they can give the investor that $7 return. So as a result, when they had a run on the bank and everyone wanted their money, they went to get out of the bonds. When they sold them at huge losses, and this is what caused a run on the bank, and this is what causes banks to fail. Bad investments. Now, my suggestion, because in that particular case, people that had millions of dollars invested were going to lose their investment. Why? Because the FDIC insurance only insures an account up to $250,000. So if you have a lot of money, I suggest you spread it around into several different banks so that your money is insured. Okay, in that particular case, there were people that had 10 million, 20 million. Now, Biden stepped up. He said he was going to get behind them. He was going to bail them out. But what does that mean? That means that you and I, the taxpayer, are going to pay for that. And we don't want to be in that situation. So we want to learn how to protect our money. All right, how to protect our money because you worked hard for that money. And it's not easy. You don't want to lose it in one swell sweep, because what's happening is we're going into very difficult economic times. And that's one of the reasons I'm doing this show. We got a downturn in the stock market. We're heading into a bear market in stocks. We have high interest rates. It's very reminiscent, for those of you who haven't lived through it, through the Carter years, where you had high interest rates, high inflation. That's what we're seeing here. So what are we going to do to protect ourselves? What investments can we make, right, that are going to make sure that we get the returns that we need to keep up with the inflation that we're seeing and have seen over the last 2 years? All right, so the first thing we want to do is we want to talk about taxes and what you can do to maximize your tax deductions. Now, on your 1040, there's a schedule. It's called Schedule 1. This is it. Schedule 1 on the 1040, and I don't know if you can see this clearly, but if you can't, go to irs.gov and download the form. First part is Part 1 is additional income. Okay, that's like if you have unemployment compensation, gambling, cancellation of debt, that goes there. That's not what we're going to talk about. We want to talk about Part 2. Part 2 is adjustments to income. Now, these are additional deductions that you could take to lower your taxes. And they have certain deductions, like the IRA deduction, which I highlighted on line 20, okay, which you can take as late as April 15th. What does that mean? That means if you were to put $5,000 in your IRA, right, you get a $5,000 deduction this year. The money goes into a retirement account for when you could 59 and a half or later, you can withdraw it without a penalty, right? And that gives you a tax deduction which lowers your taxes today. All right, so we're going to go through this list so that you maximize your deductions, maximize your refund, and pay a little bit less to the government. The first thing that they have here is educator expenses, right? If you happen to be a school teacher, they will give you certain expenses that you can deduct from your income. Now, not everybody's going to qualify for that, right? Then they have certain business expenses of reservists, performing artists, and fee-based government officials. There's a form, 2106. If you laid out money for that and you qualify, you can take that deduction. And here's one we could all take. It's the health savings account deduction. It's form 8889. What does that do? That means you put money into this. Let's say you throw $3,000 into it. You have the opportunity now, whenever you lay out money, you go to your doctor and your doctor says there's a $25 copay, you can get that copay back. All right, but now what you're doing is you're deducting it from your taxes. So you've lowered your taxes, and basically all those deductions that you laid out get returned to you. All right, and that's something that I used to use when I was on the job. Put $1,000 a year into it. What happens? I use that, I get that money back because that's the, me, my wife, my kids, we go to the doctors and it would be reimbursed through the health savings account deduction. Moving expenses for members of the armed forces. If you happen to be in the armed forces, you'll get deduction. It's a form 3903. You also get a deduction for self-employment tax if you have to pay both sides of that Social Security tax. And I do want to talk about Social Security for a little bit. One of the things that I did that I didn't mention was I ran for Congress. And when I ran for Congress in 2020, one of my platform items was to restore Social Security to the way it was originally. And for those of you that don't know the history of Social Security was signed into law by FDR on April 14th of 1935. Now, there's three provisions that he put in that law to get passed. Number one, that Social Security would go into a separate trust fund. And this was very, very important, that money wouldn't be touched, okay? And the second thing, well, we're going to come back. We have to take a commercial break. So as soon as we get back, I'm going to get more into Social Security. We'll be back in a minute.
Tax alert! Tax alert! I was receiving letter after letter from the IRS.
I got Mike Vilardi on the phone and I said, Mike, I got a problem.
He took the pressure off my shoulders.
He just made me feel like I had Superman on my side.
Trust me, he's the man to go to.
IRS problems? I'm Mike Vilardi, enrolled agent. I can help. My company, Winning Tax Solutions, has always gotten our clients the best possible results. Visit us at winningtaxsolutions.com or call us today.
You're watching Mike the Money Coach, where we talk about tax tips, money-making techniques, retirement planning, and more. Now, welcome back to the show.
All right, welcome back. So I was explaining Social Security, how it came into being on August 14th, 1935, when FDR signed that bill. There were three provisions that have since been reversed by different Democratic administrations. The first one was the fact that it went into a separate trust fund. Now, for years, from 1935 until the Johnson administration, when it was reversed and it went into the general fund, Social Security was put in basically to a lockbox, which I believe should be restored. It's important that we keep Social Security for our seniors. There are so many people that rely on it and need it that we can't let that program fail. Now the second thing, which again I want to restore, is this. FDR said that any Social Security taxes that would be taken out would not be taxed federally. What does that mean? If you make $100,000 and they take out $10,000 for Social Security and Medicare, you're only supposed to pay tax on the $90,000 that you got. But that was changed numerous years ago. And when it was changed, now you don't get that $10,000 deduction. So what happens is you make $100,000, they take 10. Instead of you paying tax on the 90, you've been paying tax on the 100. You're basically paying tax on $10,000 you never got or received. And that's one of my platform items when I ran for Congress, was to restore that. And I think that's something that needs to be done. People need to be made aware of that. That is basically double taxation. They take the tax from you, then they tax you on something you never received. It's totally wrong. And FDR, like I said, when he passed the Social Security Act, he made sure that wasn't going to happen. But again, that was reversed. And thirdly, Social Security was supposed to go to its recipients tax-free. So if you're 90 years old and you get a Social Security check, that was supposed to be tax exempt. And guess what? Joe Biden and the Democrats changed that when Bill Clinton was president. And now your Social Security benefits can be taxed up to 85%. Well, that's huge. So I think we need to let our legislators know that that isn't right, and we need to restore the way FDR signed it into law. That's very important. And since we're talking about Social Security, I want to talk about retirement now in this particular section, just to give you some more tips, and then we're going to go back into, the adjustments to income that could save you money on your taxes. This is very important that you go through it. All right. Now, they'll give you, if you are self-employed and you pay the full boat of Social Security, you would get an exemption here for self-employment. The self-employment tax. You fill out a Schedule SC and you get half back or credited to you. So that's an important thing to do. You also get a self-employed health insurance deduction. So if you're in your own business, you're paying health insurance, make sure that you take this deduction that the government gives you. Anything that the government gives you, you want to take. If you're paying alimony, it's a deduction. Make sure you record it. But the most important reduction of all is the IRS deduction, the IRA deduction. Why? Because you can write a check to your IRA on April 15th and reduce your tax liability that day for what you owed last year. So if you're going to owe money to the IRS and you can avoid it by putting money into your IRA, I suggest you do it. Why? Because when you sign a tax return, you sign it under penalties of perjury. What does that mean? That means that you're swearing that what's on the return is correct. And if you go to the IRS and you say, I owe you money, then it's no longer your money, it's their money. And what happens? Well, that gives the IRS the right to take your bank account. Come after the money because you said it's theirs. It's no longer yours. You said, IRS, I owe you $3,000. Immediately, you're going to get a letter. It's going to say you need to pay the $3,000. You're going to have to pay the $3,000 with penalties and with interest. You don't want to be in that position. The IRS is not somebody you want to owe money to. So if you are looking at having a liability, you need to use that IRA deduction, because you can do it until the last day of tax filing, April 15th, to avoid having to pay them, having to owe them money. So it's a great little technique that can save you money last minute. If it looks like you're going to owe money, it's better off to borrow money, put it in an IRA, take the deduction, and not owe the IRS. Because the last thing you need is the IRS penalizing you, charging you interest. They charge you interest even on the penalties, and giving them the right to come seize your bank account. Because you said to them, it's your money, it's no longer mine. So you don't want to do that. That's a real big problem. And people don't understand that. So we need to make sure that every year when we file a tax return, that our taxes are paid in full before we file. So we don't owe them anything. So make sure that your withholdings are correct going in. See, the IRS works on what's called the pay-as-you-go system. Well, what does that mean? That means at the end of the week, if you get a weekly paycheck, they take taxes out. As you earn the income, you're supposed to pay the taxes over to the Internal Revenue Service. That's what a pay-as-you-go system goes. So what happens at the end of December, your taxes are already supposed to be paid for the year. Now, they'll give you until a couple of weeks in January to do it. But if you owe money in April, you're already late because the taxes were actually due on December 31st. So one of the techniques to avoid that situation, again, is using that IRA deduction as a tool to lower what you owe for this year. And it's one of the only things that we have available to us that where we don't have to pre-plan it. So it's an important tool and you need to be aware of it. And that's why we're spending the time to go through what deductions you can take and when you can take it. Now, the other thing that they give you a deduction for is student loan interest deduction. So if you are paying a student loan and you are paying interest, you can deduct that against your income. All right, that's here on line 21. And there are a couple of other adjustments, minor things, jury duty pay, deductible expenses related to income reported on line 81 from the rental of personal property engaged in for profit. All right, these things, certain attorney fees are deductible. If it's for court costs you paid in connection with an award from the IRS for information you provided that helped the IRS detect tax law violations. Attorney fees and court costs for actions involving certain unlawful discrimination claims. So I suggest that you download this form, right, from when you do your return every year, and look, it's the Schedule 1 of the 1040, and make sure that you are maximizing what you can deduct from your income. Very important. The next thing is, of course, we want to plan our future. We want to plan our retirement. And next week, we're going to start with the different techniques, how to make money, how to keep it. Now, you can make all the money in the world, but if you don't get to keep it, it doesn't mean anything. So that's why tax planning becomes so important going forward. So let's talk about that IRA deduction. The first thing we can do, if you're 50 or over, you have the ability to do what's called a catch-up contribution. Well, what is a catch-up contribution? It's a type of retirement saving contribution that allows people ages 50 or older to make additional annual contributions to qualified accounts. Now, in 2023, eligible workers can contribute an additional $1,000 to an IRA and $7,500 to a 401k on top of the standard $6,000 and $22,500 contribution limits, respectively. What does that mean? That means if you're over 50, you can deduct up to $7,000 for your IRA deduction. Well, that could be significant, especially if you can hold the IRS $2 or $3 grand. That could wipe out your liability totally, and that's what you want to do. Now, okay, so right now we're going to go to a commercial break, and we'll be back with the last segment in a couple of minutes.
Text alert! Text alert! I was receiving letter after letter from the IRS.
I got Mike Vilardi on the phone and I said, Mike, I got a problem.
He took the pressure off my shoulders.
He just made me feel like I had Superman on my side.
Trust me, he's the man to go to.
IRS problems? I'm Mike Vilardi, enrolled agent. I can help. My company, Winning Tax Solutions, has always gotten our clients the best possible results. Visit us at winningtaxsolutions.com or call us today.
You're watching Mike the Money Coach, where we talk about tax tips, money-making techniques, retirement planning, and more. Now, welcome back to the show.
Welcome back to the show. All right, because it's tax time, it's April, and taxes are due, I think it's important that we focus on taxes and how we can save you money before you file that return. And like I said, we were just talking about that IRA deduction, which is very important. Now I want to talk about the SEP IRA, which is for people who are, self-employed, officially known as a simplified employee pension. A SEP IRA is a variation of a traditional IRA as the easiest plan to establish and operate. It's an excellent option if you're a sole proprietor, though it also allows for one or more employees. So if you're in your own business, and it's very easy not to plan for your future. I know people who've been in their own business since they were in their 20s and never set aside any money for retirement. And now they're in their late 60s and they still have to work because they have nothing to fall back on. You do not want to be that person. You do not want to be in that situation. So we want to take advantage of anything the government's going to give us as far as deductions to put away for our future. And an IRA is a great tool because you can compound it, you can make a fortune with it, and then when you take it out, theoretically you'll be in a lower tax bracket and you'll pay less in taxes than you would if you didn't take the deduction now. So let's talk about that. How a SEP IRA works. The employer contributes to a SEP IRA, not employees. Right? So unlike the solo 401k, you only contribute wearing your employer hat. The plan also offers flexibility to vary contributions, to make them in a lump sum at the end of the year or skip them all together. So you have some flexibility since you're going to be the sole owner of the company. This is a great way to save money when you have it, when you earn it, boom, you can put it away. Its simplicity and flexibility make the plan good for a one-person business. But there's a catch if you have people working for you. You do have to contribute to the plan each year, and when you do, you need to do so for all eligible employees. In other words, what the government is saying is this. You can't have special rules just for you because you own the company. Anything you do for yourself, you have to do for your employees. And it's only fair. That way, you could offer a very generous plan for yourself, but your employees would have to also benefit from that. So when you set these up, you have to understand that the government basically regulates it by saying, if you're going to take a deduction, that's fine, but you got to make sure you get the same deductions for all your employees. Why they want fairness to everybody, and it just makes sense. All right, so what are the rules and how much money are we talking about here? You do not have to contribute to the plan each year, but when you do, you need to do so for all eligible employees, as I said, up to 25% of their compensation, limited to $330,000 in 2023. That means you can take a quarter of your pay and tax defer it, which is tremendous. So if you're in a situation where you make $100,000 a year, you can take $25,000 of the 100 and put it away for your future and tax defer that. And that's a great, great opportunity, especially as we have an administration where taxes, they want more and more taxes out of you. So put it away, tax defer it, okay? While SEP IRAs are simple, they are not necessarily the most effective means of saving for retirement. You can contribute to more to a SEP IRA than a solo 401k, excluding the profit sharing, but you must make enough money since it's based on the percentage of profits. All right, so you got to keep that in mind. How do you set it up? The account is simpler to set up than a solo 401k. You can easily open a SEP IRA online at a brokerage. Okay, and that's very important. So we want to save you money. Now, that's going to bring us to the last segment of the show. We're going to talk about Social Security. Again, as I said, my conviction was we should go back to the way FDR passed the Social Security Act. Social Security, I believe, should be tax-free to the recipients, and there should be no double taxation. You should be able to get a tax deduction for the money they take for you for Social Security and Medicare benefits. And if I ever do run for office again, that is going to be another platform item because I really feel strongly about it. We want to help our senior citizens. Now the question comes down to when do we take it? Well, 65, right, is the normal retirement age, but you have to look at your situation. Sometimes it's best to take it at 62, even though you get less of an amount. Sometimes it's better to take it at 70. So we have to go through the different scenarios because what none of us know is the day we're going to die. And really, that's the only way to plan this, right? If you're only going to live to be 65, you want to take it at 62, don't you? If you're going to live to be 105, you want to wait until you're 70 so that when you're 105, you can still pay your bills. That's the bottom line. Well, I'm going to be back next week talking about the old-time masters like Jesse Livermore and W.D. Gann and how we can make money in different commodities and different things. And of course, we're going to talk about current events like the banking crisis so you understand what's happening. So my advice to you for today is if you have more than $250,000 in any one bank account, diversify so that if there is a run on the banks, you don't have to worry about your money. So be very cautious about that because we are going into very perilous times. You can see what's happening with interest rates going one way. Now oil prices are going up. And as oil prices go up, that means inflation is going to spiral. So I hope you enjoyed today's program. We'll be back next week. I'm Mike the Money Coach. Thanks for watching.
You've been watching the Mike the Money Coach Show, where we talk about tax tips, money-making techniques, retirement planning, and many more. Join us again next week with Mike the Money Coach.